All right. It's Tuesday, the 30th of January. Guy Adami, Dan Nathan. Today we're joined by a legend, Jim Chanos. This is Market Call, the last Tuesday in the month. Thanks for joining us. Much nicer day today. You can see behind me that there are people actually in the pool. I heard there were some things going on yesterday, Dan Nathan, that I was not made aware of. I wish I was. But today's Market Call, we got Jim, and I'm thrilled. By the way, today on Fast Money, we got a big short panel.
Yeah.
Think about that. Those four cats from the Big Short just here on stage at iConnections. They'll be joining us on CNBC's Fast Money. We have Mr. McKnight coming from Fortress. That's a huge get.
Yeah, we do.
Blythe Masters, I think, is coming on the show.
Big show.
So it's going to be a big Fast Money.
So here's the thing, a little preview here. So Melissa Lee, host of CNBC's Fast Money, she just interviewed Steve Eisman, Danny Moses, Porter Collins, and Vincent Daniel, and that was straight fire. Isn't that what the kids say, Guy?
I don't know what the kids say, but the room was filled and people were excited.
Right.
And they're like Big Short groupies out there.
There are.
Like, OMG.
Yeah,
like, my mom loves
Kendall
you.
Cat over here is big fan. All right, let's focus on, because we have a legend right here now with us. And I know he doesn't love that, but this is Jim Chanos. He is the founder of Chanos & Co. We've known Jim for an awful long time. I think a lot of investors out there know him prominently for some pretty big short situations of your own, Jim. Welcome, bud.
Hey, good to be here. I was in the neighborhood, thought I'd stop by.
Well, you're a gentleman, Jim. And, we're going to, let's just go through the rundown real quick, because there are some parallels here to the dot-com bubble. Parallels.
Yep.
What's next for Tesla? It's obviously had a huge downdraft, traded down to 179. Technical support held, bounce. We'll see. What do you like in this market? We're going to talk about that. And obviously some big tech earnings starting tonight, firmly in the face of Microsoft, which finds itself with a $3 trillion market cap. But before we get into that, so much of the market, at least the textbooks that I read, the market should be built on earnings, earnings growth, revenue, and revenue growth. That should be the four pillars of the market, which I totally get. And you were saying before the show started that you were hearing anecdotally or seeing that some of the estimates are coming down in a major way. So let's go from the top down and look at earnings and sort of what you think is going on in the market.
Yeah, well, it's a quaint notion that you think that earnings and rates are.
It is old-fashioned. Yes, thank you for that.
I don't look. Macro is not my forte, as you know, but it's hard not to notice that earnings estimates are coming down, not going up. I have no idea where interest rates are going, but the point is that, as always, as analysts generally are too optimistic. Now, there was a couple-year period where they were not optimistic enough, right? Where earnings accelerated. But now we're back to the, estimates come down as the year goes on. And we're seeing that with 2023 numbers. The fourth quarter seems to be coming in pretty weak for earnings, strong GDP. But I don't know. Are we going to see $240 in 2024 earnings for the S&P? Seems increasingly unlikely.
Yeah. So it's interesting, the idea that the stock market has been keying off what forward estimates are, and what I think we've seen over the last few years, and definitely since COVID in a way, is that strategists have been a little apprehensive to take big whacks at their forward numbers, right? So it's kind of death by a thousand cuts. And to your point, we covered this yesterday a little bit. It was a note out of FactSet, our main man, John Butters, the earnings insight analyst.
Stop for a second.
What's that?
It's not. It's just Butters.
It's just
like
Butters.
Share.
I know. I just want to make sure.
Pele,
yeah,
it's like Quinalia.
It's like Chanos. It's the same thing. All right, but here's the deal. And we read this quote, Jim. This is pretty fascinating. The top 6 stocks in the S&P 500 are expected in Q4, and a bunch of them are going to report this week. They start tonight. 54% year-over-year earnings growth. The bottom 496. Okay, the bottom 496 for Q4 expected to be down 10%. That doesn't feel like a healthy earnings environment, right? And when we're looking at the market today, Guy, I see two disasters right now. I see UPS trading down on their earnings and guidance. I see Schlumberger comes out, SLB, down a whole heck of a lot. And these are, I think, kind of economically sensitive, not part of these big secular shift ideas and that sort of thing. So, Jim, how often do you look at single names and reactions to an earnings event like that, and given the guidance that they've just given, and try to extrapolate a little bit broader? Because you started out by saying you think estimates for 2024 S&P earnings are high. Is this earnings season so far, and again, we haven't had the big ones, is it giving you more confidence in that view?
Well, I mean, my past life as of a few months ago, as you know, we're generally long the indices and short idiosyncratic risk. So I still think that's a wise strategy. And generally, look, the indices are self-reinforcing in both good and bad ways, right? They keep rewarding success and weed out failure. That's in many ways why they're so hard to beat. But it's hard not to notice that we're increasingly getting a really bifurcated market where people believe a handful of stocks can do no wrong and no price is too high to pay, and the rest of everything else struggles.
Well, JP Morgan Call will put this slide up. They're talking about, again, .com style concentration in the market. We'll put the slide up and you can read it. And then you look at the top 5 weight in terms of what we're seeing now, and the comparisons in terms of what it's doing to the market are eerily reminiscent to what happened some 25 or so years ago. Nobody wants to acknowledge that, but it's happening.
It's even worse than that. I mean, a lot of us are focused on the top 6 or 7, take your pick, stocks, but there's also a pretty healthy subset of momentum, growth, consumer names, whether it's in the restaurant space, whatever, that trade at kind of absolute insane multiples because they haven't disappointed. You know, chicken wings at 120 times earnings, and you know, all kinds of consumer
I'm going to stop for a second because
times.
your point is spot on. Like a CMG, for example.
Yeah.
Every quarter they surprise to the upside.
Yeah.
And they get rewarded in terms of their valuation and the subsequent stock price. That stock seemingly makes an all-time high every single day.
Right.
But what I think the point you're making, and correct me if I'm wrong, it's when they disappoint, that's when everybody's sort of head pops up and said, what happened here? And that's when you start seeing the normal reaction in terms of the stock market. So until you get these disappointments, it's just going to be on autopilot to a certain point.
Yeah, and everyone knows that. But the problem, of course, is this math, right? And that if a CMGI or what have you is going to grow 20 points greater than nominal GDP for the foreseeable future, in 30 years, we're all going to be serving burritos to each other.
All right.
So I mean, that's not going to happen. Obviously, the growth rate is going to slow down.
By the way, I don't know if you know what you just did there. You just said CMGI, which brings us back to 3,000. Sorry. So that is a pretty fascinating thing. And I'm going to tell you something. I was on the beach in, this was late 2002, okay? And I bumped into a guy that I used to work with without naming names at a hedge fund, the first job that I had in the business back in 1997. And this guy, and I'll say offline who he was a known tech short seller. When I tell you that he nailed the top of many of these internet names, and I saw him on the beach, and it was like December 28th or something like that, 2002, and he's wearing a CMGI hat. And I remember that. I said, what's up with that? He goes, I rode the whole thing down to zero. He never even
was a CMGI field, wasn't there?
Yeah, I guess there was. All right, but I want to, so going back to the .com era, guy, you just mentioned this JP Morgan note. Let's throw it back up there. The share of the top 10 stocks of the MSCI USA index, including all of those so-called Mag 7, has risen to about 30% by the end of December. That's just moderately below the historical peak share of 33% in June of 2000. The key takeaway, extremely concentrated markets present a clear and present risk to equity markets in 2024. And I just want to make this point because we just listened to Melissa Lee interview Steve Eisman, Danny Moses, Vincent Daniel, Porter Collins, our big short friends. And it was interesting because Steve pushed back on this whole notion. For 40 years, people have been whining about the debt, right? And it's not, all right. So we've been whining about the concentration, okay? But here's what I want to ask Jim about. And I know you're not a rates savant or guru or this and that, whatever. But the longer this goes on, this concentration, or the more pronounced it gets, and if rates don't go the way that a lot of folks hope they do this year, does that make the problem that much more acute?
I think all things being equal, yeah. But I would actually deflect the question and say one of the things that by 1999 could have told you were getting in the later innings of the tech bubble in the late 90s was when you began to see a big drop off in the quality of the earnings of the big tech guys like Lucid and Cisco, whatever. And a number of these companies got into the business of not only doing barter transactions, but also having venture arms invest in companies who then bought their product, right?
You're seeing that around the edges now.
I was going to say, you're beginning to see, people are beginning to report on, which I think is a good thing, the fact that some of these companies now have reasonably large venture operations under the corporate umbrella and are investing in companies that are turning around and buying their products. I would also point out to a couple of small companies like Microsoft and Google, who are increasingly capital intensive because of their data centers, who are cutting their depreciable lives, which is a a one-time thing that will help earnings for a while. But the longer this goes, if we start to see more and more big cap tech companies begin to use more and more fun and games to make their earnings estimates, then the parallel with 99 2000 is going to be hard to miss.
I don't want to play stock market with you, and I'm not necessarily looking for your Apple call, but my first question is, how important is a name like Apple to the broader market? I asked that because last I looked, Apple, I think, was in 314 ETFs, of which Apple was in the top 15 holdings. So it's become its own asset class. And in a world of passive investing where money just flows in each and every day, Apple wins to that more than any other company out there. But we're seeing anecdotal news. We saw some news today about shipment declines, 15% or so. The stock is actually underperforming the broader market today. Apple actually does go down. But my question is it a very important market barometer? Do you watch it closely?
No, I think stock you're probably going to hit me over the head with is much more important, Tesla.
All right, so stop for a second. Fair enough. Tesla is now more than 50% below the all-time high it made, I think, in 2021 or so. I thought stock was north of 400. It obviously traded down to 180 recently. It's bouncing today. That's on a broader market that's done extraordinarily well. So where I would agree with you, yes, but the market doesn't seem to say the same thing.
Well, the market got really insane. Now it's only slightly insane. But the reason I think Tesla is important for getting its market cap and the fact it's down 50% is that, to me, it is like Cisco was in 99, 2000. It's the hopes and dreams large cap tech stock where people can put any business model they want to on the back end of it and say, I can overpay for this company because they're going to implant chips in my brain. They're going to have a robot serve me breakfast every morning. They're going to get me to Mars and God knows what else. I keep saying he's going to announce asteroid mining soon.
There's a salve for that, by the way. That's something else. I apologize. My age.
But if you look at, and I think you know this, if you look at options trading, Tesla's number one almost every day, ahead of the S&P, ahead of Apple. And so this is the speculative vehicle of choice. The other thing I love, the paradox of Tesla, is that for everyone that says, well, I'm owning it for the 2030 robotic earnings, whatever, it jars with the fact that Tesla turns over its public float every 5 weeks. Yeah. So when people start talking about being a long-term investor, they're trading it like maniacs.
Listen, I think we can kind of put the Tesla story to bed for now. And I'll tell you, well, I know that it becomes hard. But like Guy made this point on Fast Money last night. You had this move. The stock was down 20% into that earnings print. The next day, it was down 12% because it was just a disaster of a quarter. They didn't give guidance. The call was a mess, right? But it's going to fill in that gap. And then, as Danny said this morning on the panel, but there's going to be a good opportunity to reshort it if you can be tactical. The reason why I say we can put it to bed is all of the pillars of the bear case over the last 5 years that you have made, okay, they're coming true. The competition, just the sheer economics. Did you see the BYD overtook them? I know you saw that in units, but did you see the guidance that they just gave? They are willing to fight a war, a price war that Tesla shareholders, I just don't think at a $500 billion market cap are going to be willing to stick around for, because ultimately it's just turning into that auto story. And if you want to keep pricing it on 2030 robots and all this other crap, have fun. But like we've been saying this for a long time, this is going to be the last battle fought in this market.
All right, so here you go. So again, we play this game on Fast Money. If I had told you, and I'll play it with you now, if I had told you that Tesla would be cut in half over the next couple of years, way back when, and say, where's the broader market? If Tesla is an indicator of such, I would say, well, the S&P's got to be at least 4,000, if not lower. Obviously, we're at all-time highs. So I understand that. So my question to you is there a catalyst that you see that could potentially derail this market? Like, what are you looking at that a lot of people don't talk about?
Well, first of all, let me, again, flip just your premise a little bit on its head, because if Tesla's important, particularly to retail investors, whatever, the typical retail stock has not done as well as the S&P since the peak, right?
Fair.
So it is, I think, a bit of a bellwether. Having said that, look, what derails things are things that are unexpected. And it was inflation finally appearing in 2021, 2022 that gave people pause. It's come down now. A year and a half ago, people probably would have said, well, the Fed wouldn't be embarked on an easing program right away. Now they're counting on that. So it's going to be things that are unexpected, and that's why this is such a tough game, right? And I don't know that you can predict that stuff, and I argue that you can't. The difference is if you get it wrong, what's your risk reward, right? And if prices are where they are right now, if something unexpected happens, that's the risk.
Yeah, I would make the case, Jim, that if you go back in 2021, the S&P topped out in the first week of January 2022, but large pockets of risk in the stock market, in the crypto market, SPACs, I mean, the list went on and on, were careening lower already.
Yeah.
Okay.
Fourth quarter of 2021.
And I think you can make the case that what's gone on right now in Tesla over the last, let's call it, few months is not too dissimilar in a way. And to your point, Guy, about this concentration in those other names. So we lost Tesla out of the Mag 7. Let's see what happens. I just want to make one point about this Apple. And again, I know that, who cares? The stock on a relative basis, and Carter Braxton Worth has made this case on Fast Money and on Market Call again and again. This is the largest market cap company in the U.S. Relative to the S&P, trades horrible. So relative strength is really important. So when you think of the exuberance that has existed around Tesla, and the relative strength is a disaster. It went into the S&P 3 years ago, a little plus, at $232. It is trading below $200 right now. So it's in all of those index funds. It's trading horribly now. And if we start to see other pieces of this mega cap tech upper echelon start coming undone, listen, Nvidia just gained 25% in a straight line in a freaking month. Okay, it's got a $1.5 trillion market cap.
You're yelling. Why are you yelling at us? Jim and I are your allies
You can make the case. I do a little Stephen A. thing right here. You can make the case that the stock is cheap still, given the demand and blah 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 blah. But it just pulled forward so much enthusiasm. So if they just show a mild deceleration when they report in a month, that stock's going lower. Microsoft tonight. Let's talk about Microsoft. Let's talk about AMD. That's literally doubled in the last.
Well, let's talk about Microsoft. Okay, so let's break it. Microsoft first. Just again, crossed $3 trillion, north of $400. Stock has had an epic run over the last couple months on the back of the things that you've talked about. I've said this. I believe it to be the case. It's one of the 5, if not 3, most important companies in the world for a myriad of different reasons. However, in terms of valuation, it's been rewarded and then some. It's probably trading, I want to say 31 times ish next year's numbers, which is expensive historically, obviously expensive to the market, and it doesn't sort of jive with the earnings growth and the revenue growth that they have. So I'm not asking you to get drilled down in Microsoft, but that to me is almost one of the poster childs of what's going on here.
Yeah, well, that's because the AI component of Microsoft is getting a 100 multiple.
Well,
right?
So stop for a second. So last night we had Brad on the show on Fast Money, and he talked about Nvidia being actually relatively cheap compared to the growth rate and the things that they were seeing. You saw super micro computer. They guided a week ago on the 22nd. They reported last night, blew things away. That stock was parabolic this morning. It's seemingly coming back to earth. But at what point is things not only priced in, but double, triple priced in?
Apparently not yet.
Fair.
With short data centers, they're trading at 100 times earnings.
Fair.
And AI puts some of them out of business. So, I mean, it's not today.
Yeah. So interestingly, we also have a Fed meeting tomorrow. Okay. So this is kind of important. And I think expectations for what the Fed might say, like I guess, if you wanted them to be dovish, if you want them to signal at their next meeting in March, right, that they are going to cut interest rates and what the Fed funds is pricing, you know what I mean, maybe gets accelerated because inflation's coming down and the like, then that should buoy equity valuations. But if they do not, okay, and nothing's being priced for that right now, okay, and then this week we have, let's say Microsoft doesn't give the guidance just the way that they did in July, right? Let's say AMD pulled forward a lot of enthusiasm in the stock price relative to what they are able to guide for this quarter and maybe the balance of the year. And let's say Google, believe it or not, people, this has been the redheaded stepchild of the AI stocks. Can't say that anymore?
No. There are a lot of things you can't say that.
I love the redheads.
I mean, a lot of people at the pool. I guarantee you.
I love the redheads. But again, I mean, so there's a lot of things that could happen that might not be supportive of 19.5 times S&P 500 earnings, especially if interest rates are not expected to go down as much as people were pricing, let's say, a month ago. Does that make sense, Jim?
Yeah, but I mean, first of all, there's 8 people in that pool have a better insight into the Fed than I do. So number one,
doubtful.
I have no idea where rates are going. But let me just point out to you, as we talk about Microsoft and AMD and Nvidia, there's a whole bunch of companies in my world that just lose lots of money, right? That report hundreds of millions of losses per quarter that are up 4x from October. I mean, and really, I mean, back to many cases,
what were they
2020.
pricing? A no landing, soft landing, rates going lower though.
No speculation. No speculation. That's what they're pricing.
Right. Yeah.
And or, you know, short covering, whatever have you. And by the way, the short interest doesn't drop on these names, so it's not short covering. But you know, problematic business models that have lost money for the last 5 years and show no signs of making any money. And yet those stocks went up as much as Nvidia and Microsoft and AMD, and they've come in some more than the big six, but are still up a ton from just 4 months ago. And so, you know, this is a market with a lot of animal spirits in it.
If we play another game, as I mentioned earlier, if I had told you, I'll play it again. So over the weekend, we heard from a couple of United States senators, Lindsey Graham, John Cornyn, both said effectively, I'm paraphrasing, bomb Tehran, something to that effect, right? That was out there. I am shocked that the reaction of the market was as muted as it was. I mean, so my question is concerning geopolitical risk, which is seemingly as bad as it's been, I want to say, in the last 30 or so years, yet no impact whatsoever on the broader market.
Middle East strife hasn't made an impact on markets since 73, 74. So, I mean, for people that are looking at Middle East issues, most investors just go, it's a mess. We're going to be there, kind of. There's going to be terrorism. It doesn't factor in. I do think that something happening in the Pacific.
Let's talk about that.
It would be a much bigger thing.
What is that thing that happens in the Pacific? I mean, again, China, our relationship with China is probably the worst it's been in 50 years. You can debate it. I happen to believe that's the case. Obviously, the saber rattling in terms of Taiwan. When President Xi was in San Francisco in the beginning of December, it came out 3 weeks later that he said, and again, I'm paraphrasing, we will take Taiwan by whatever means necessary. That came out in the press, I think, in mid-December. So that's out there as well. I mean, nobody seems to be focused on it. Maybe, again, they think it's just rhetoric. What are your thoughts on that?
Look, I think that the real risk, and we've been saying this for a while, is that he gets more aggressive in foreign adventures to distract people from what's going on domestically in the economy. And the fact of the matter is they cannot get the domestic economy going because of all the things that we've discussed down through the last 15 years, and that the model is a bad model and it's coming to the end of its useful life. And they don't want to address the realities of changing their economic model, which is based on investment in property. And so I don't know what he does, but boy, the rhetoric is not good. And he has made threats. And that would be, you know, the curtain dropping there would be something I think.
Okay, so I've brought this up, and actually the people agree, disagree. I'm curious as to your thoughts. A lot of people think that because of the weakness in China, it makes them less inclined to do something with Taiwan. My pushback would be it makes them more inclined, I think, for the reasons you just cited, sort of taking your eye off the ball as to what the problems are, and then creating sort of a bit of a divergence of that, for better word.
Until Xi Jinping, the deal with the citizenry was don't get involved in politics. The Communist Party knows best, but we will give you prosperity. In the last 5 to arguably 10 years, the prosperity engine has slowed down and sputtered, and now it's becoming support us nationally, as in nationalism and patriotism and the greater China. And that's a change. It's a big change. And so I think that the economy struggling makes the risks worse or higher,
so
not
Jim,
less.
You've been making a fairly bearish case about China.
You might say so,
for a decade. But the stock, I mean, look, I'm looking at the Shanghai Composite. I mean, it's really trading where it was a decade ago. I mean, when you think about that, right? And then if you think about U.S. companies and all the excitement over this last decade about access to a Chinese consumer that is growing at a scale that we've never seen. But then if you look at really how the Chinese consumer has been exposed to risk assets, it's been in the very thing that you've been warning about for a decade. and that is commercial real estate, right?
And
They have-
residential
real estate. So they've had much more exposure to real estate, both commercial and residential, than they have to the stock market. But yet we sit here.
Much greater.
Okay, so when you see a headline like we saw last week that the Chinese are going to command the SOEs to repatriate maybe $300 billion and put it into the stock market, the stock market like rallied and then it sold back off. Wouldn't they have much better use of putting that to kind of stem? We saw the China Evergrande story and stuff like that. I mean, is this finally coming undone right now?
I don't know that it's coming undone. I think you're just seeing the flaws in the model, which is the Chinese stock market. When we did our bear call on China, the FXI was $41. I think it's
$22. Right
$22. So it's almost been cut in half since 2009. But if you actually look at the market cap of the Chinese stock market, it's up. Now, okay, so what's the paradox? The paradox is they're diluting the hell out of you, right? There's so much agency risk in China, it's not funny. And who's the patsy? Western investors are the patsy. They've provided capital over and over again through the VIE structure, which we've talked about till we're blue in the face, which is a complete fraud. And because China sold them on this growth and you want to be part of our growth and whatever, and meanwhile you've done nothing but basically provide capital for them to do other things. Having said all that, the problem, the property market dwarfs everything. After US treasuries, it's the most important asset class in the world, Chinese property. It doesn't get the attention it should, and that's where China has its savings. That's where Chinese populace is counting on the price of their flat to provide for their retirement and their kids. And if that doesn't happen, and if that doesn't pan out, then you're going to have political issues.
Okay, so I think we'll end how we began in terms of our broader market. There will people that will say, for all the reasons you just cited, obviously China being as important of an economy it is, that's the reason, the weakness you just cited is the reason why you should pay a premium multiple for the S&P 500. And as you talked about earlier, if we're looking at $225 of earnings ish, you're talking about a market right now that's trading about 21.5, 22 times, which again, historically is expensive. But does that argument make sense that the weakness elsewhere in all these different pockets is the reason why you should pay up to be in the United States?
I don't know that follows necessarily. I mean, I know that argument can be made, but just because I don't want to pay, for Chinese stocks doesn't mean I should be paying up for something else ipso facto. So I don't know.
You think cash pays okay right now?
That what is
cash?
Look, I mean, people should always have some cash. I think the cheapest thing out there right now is insurance. I mean, the view is that I insure things that are valuable in my life, right? And your residence, your life, your possessions, your car, you do too. And right now, insurance for financial assets in the U.S. is about as cheap as it's been ever.
Oh, we know. We talk about it
here
every day.
Talk about the reasons why. Because if the market seemingly goes up every day, I think market participants, which used to buy that insurance and was a drag on their returns, at some point they said, you know what, we don't need to do this anymore.
No,
and then somebody woke up and said, you not only would have to do it anymore, we can sell these things and get paid. We can actually enhance our returns.
We can sell the insurance.
So that's where we are. Speak to that.
Yeah, no, I think that's exactly right. And now people not only have eschewed buying it to protect portfolios, but are actually there are strategies that are huge that are selling insurance to people like me or elsewhere that basically say, okay, I'm willing to take that unlimited risk to the downside because I can make some extra nickels, and that's what's terrifying because that's when the black swan of the true black swan event, whatever, bankrupts just people that never knew they were taking those risks. And I think that we saw that a little bit in 2008 and well, a lot of it, and with people selling CDSs and in an asset class that got vaporized for 9 months and put a lot of people out of business, and it can happen, and it has happened. And so it scares me to see all these strategies that are, there's a Tesla ETF that sells puts. to make income.
No, they've created all kinds of weapons of mass destruction. Warren Buffett talks about.
And meanwhile, the actual insurer, I mean, we price put baskets for our clients. We just priced one this past week, and it's as cheap as it's been in since the fourth quarter of 2021.
Yeah. Well, I'll just say this, and we can end on this. You know, a lot of the behavior in the stock market and some related risk asset classes last quarter, Q4 of 2023, reminded me an awful lot of Q4 of 2021.
Yeah.
And I got to tell you, January, while we up a whole heck of a lot, especially off those lows, okay, everybody's in the pool now. And there and some of the issues on the concentration front and the expectations about rates and the expectations about growth and all that sort of stuff, I think it's setting up very similarly to early 2022. So I think you better strap in here, people, because I really do think we are on the cusp of a pretty sharp decline in the Q1 of this year.
Sitting on a desk with Jim Chanos is an absolute honor. We've been able to do it a number of times. So, Jim, thank you so much for your time. You're extraordinarily generous. You could be doing a lot of other things, but you spent the last half hour with us, so thank you very,
My pleasure.
very much.
Anytime, guys.
Appreciate it, brother. Thank you.
Thanks, everybody, joining Market Call. We'll be back tomorrow, which is Wednesday. I think I'll be doing it from my basement, which is my typical want to do because we're leaving this conference. But again, Fast Money tonight is going to be, what do the kids call it?
Straight fire. Hey, thanks to iConnections.
Straight fire.
They have been an amazing, amazing host to us the last couple of days. We've had a lot of great guests here. It's been just a truly great event.
Day two of this conference is remarkable what's going on. I mean, we talked to people that work at the Fontainebleau Hotel. They've never seen the lobby. I mean, it's exciting. 4,300 people. Congratulations to Ron Biscardi and his team. And by the way, I think Caitlin is interviewing Eli Manning in one of the main halls right now.
Let's go.
So we should go and check that out.
Two-time Super Bowl MVP of your New York Football Giants.
Thanks, Jim. Thanks, everyone. See you tomorrow.